Okay, welcome everyone to another exclusive Apt Wealth Partners event, Investing in the Age of AI. I'm Andrew Dunbar, one of the directors of Apt, and I'll be your MC today. Now, I just want to start with some housekeeping. We've got plenty of time for questions today as we go throughout the presentations. You can submit a question in the Q&A box in your Zoom menu, and you can do that at any time throughout the presentation today, and we'll try to get to as many of those questions as we can at the end. Just a quick disclaimer before we start. What we cover today is not personal advice. It's general in nature and it shouldn't be taken as a recommendation. All right, well, there's plenty happening in the world in 2024. We've got wars, geopolitics, elections, inflation, interest rates, and then this fascinating rise of artificial intelligence. And when making financial decisions, it's easy to get caught up in these issues. So the Apt investment team, they're working hard in the background to stay abreast of all of these developments and help you make the right long-term moves at the right time. So today we're going to hear from a couple of speakers. Firstly, Sarah Gonzales, Chief Investment Officer at Apt, and then Nick Langley, MD and Portfolio Manager from ClearBridge Investments. And Sarah's going to reflect on this year and also look ahead to 2025, while Nick will give a different perspective on investing to take advantage of this AI theme. So without further ado, let me introduce Sarah Gonzales. She'll be well known to many Apt Wealth clients. As Chief Investment Officer, she provides portfolio construction solution for advisors and clients and manages the Apt Wealth portfolios with her team. Over to you, Sarah.
Thanks, Andrew. Welcome everyone to this morning's session. So this morning we'll be running through, what we've seen in investment markets over the last 12 months and how we're seeing investment markets for the next 12 months. So a quick review of what we've seen over the last 12 months. Equity markets have had a really strong 12 months, really predominantly driven by the US equity market. I mean, in 2024 alone, the S&P has reached record highs 47 times just in 2024. And that's really been supported by the continued enthusiasm around artificial intelligence, with the US equity market predominantly driven by initially the Magnificent Seven as we know them. So for those that don't know, Magnificent Seven has been made up of Apple, Alphabet, Amazon, Meta, Microsoft, Nvidia, and Tesla. But to more recently, the Magnificent Seven has kind of shortened down in a list and combined into the Magnificent Trio, being Alphabet, Microsoft, and Nvidia. As you can see in that chart there, the Magnificent Trio alone contributed 49% of returns. That's what they returned for the first 6 months of 2024, compared to the overall S&P 500, which returned 14%. So really showing the concentrated nature of the rally that has been occurring in equity markets. And, this appetite for AI has just continued to grow, and investors have been looking beyond, these Magnificent Seven. That's what we've seen, looking into companies that are providing tools or services that are connected to AI. Things like utilities and green energy stocks have rallied, which investors are factoring, obviously, the significant electricity requirements that are required for AI, and Nick will touch on this in his session. But that's really what we've been seeing in equity markets, this really concentrated rally. What we've also seen, which has been, a big factor in equity markets for quite a while now, is inflation. So what we've been seeing is inflation moderating over the last few months. In Australia, inflation's moved from its peak inflation of 7.8%, which we saw back in December 2022, and is now down to 2.8%, which we last saw in the September quarter reporting, and is within, the Reserve Bank's target inflation of 2%. In the US, inflation peaked back in June 2022 at 9.1%, and we've seen inflation come back down to 2.6% in the last reading in October 24. So this is a little bit above what the US Federal Reserve's target is of 2%, but not too far off where we see that target. So inflation really moderating from those peaks. As a result of that, what we've seen also over the last 12 months is central banks really starting to cut interest rates, the latest being the US, cutting interest rates for the first time since 2020. And, as you can see in that chart there, central banks globally have started to cut interest rates. The only, Australia being one of the few countries actually to keep interest rates on hold. Australia was one of the last to increase interest rates as everyone was increasing interest rates post-COVID. Now we're sort of the last again to start cutting interest rates. But obviously those expectations for Australia is to cut. Just when that will occur is still unknown at this point in time. And obviously one of the key things that we also saw closer to the end of this year really, over the last few months, is the US elections really having a big impact on equity markets, the unknown of who will come into the US presidential election, who will win, whether it was Kamala Harris or Donald Trump. Obviously, we know the results now. But as you can see in that chart of volatility, equity markets have been pretty benign for most of the year, or the last 12 months, as you can see in that chart. So volatility really low since December, but really started to pick up over the last 12 months from August onwards as equity markets, the uncertainty of who will win started to creep into investment markets and increasing that volatility in equity markets. So where do we see, what's the outlook for the next 12 months for equity markets? What we're really seeing is, I touched on at the start that the rally over the last 12 months has been really concentrated. It's quite a short period, but what we're seeing is that equity market rally now starting to broaden out outside of those Magnificent Seven. So as you can see in that chart, the third quarter of 24, the rest of the S&P 500 really started to outperform versus the Magnificent Seven. And so this suggests that investors are becoming a little bit more optimistic about, the rest of the equity market and looking like another positive year, not just for equities, but for all asset classes, actually, for the last 12 months ending October 2024. All asset classes, again, for the second consecutive year in a row now, that all asset classes have generated a positive return. So it's looking like a good year for all asset classes, not just the equity markets as well, for the next 12 months. And another key thing, obviously, that we wanted to touch on is, what impact will a Donald Trump presidency have on equity markets? As we all know, Donald Trump has won his second term in the US, being elected the 47th president for the US. And the Republicans actually getting control of both the Congress and Senate. This is really important for a president to have control of both houses in order to pass any legislation unchallenged. So the Republicans ended up winning 53 seats in the Senate. They have this rule in the US, which is called the Senate cloture rule, which requires about 60 Senate seats to really end a debate, or what is really commonly known as a filibuster on any topics. So that's something to end debates. So what could end up happening with Donald Trump, and it is a steep barrier, is the Democrats could just debate an issue indefinitely. So this does pose a steep barrier for President Trump to just unanimously pass his policies through. So that's really important to note as well. He'll really need to negotiate with the Democrats in terms of which policies he really wants to push along. But just looking at equity markets returns, since 1950, the S&P 500 has produced positive returns under both parties, actually, both Democratic or Republican administrations. Notably, the best returns for equity markets has been a divided Congress, as you can see there. The Americans do like their checks and balances in place, so a divided Congress has generated greater returns. But as I mentioned, even though the Republicans have power control in the Congress, they do really need to negotiate with the Democrats to really pass anything through. In terms of inflation, what we're seeing is inflation continuing to stabilize over the next 12 months. The key thing here is, as you can see, for the US and Australia, Australia coming in staying within inflation targets for the RBA, and the US just a little bit above where the Fed target is for inflation, but really within that range of inflation targets that we're seeing over the next 12 months. Probably the key thing to note here is that inflation, while it is stabilizing, it is higher than where they were 10 years ago. So inflation is still elevated compared to what we've seen historically, but it is stabilizing and starting to fall within central bank ranges. Another important factor that we look at is bond yields. The reason why we'll look at bond yields, it's sort of considered as the risk-free rate. It's not 100% risk-free, but it's a good proxy for a risk-free asset. And this is really used for a lot of factors actually in investment markets. It determines the borrowing costs for companies, it impacts evaluations on assets, and it also is also a signal for inflation expectations moving forward. And so since October, as we saw there, bond yields suddenly did jump for a number of factors, being stronger than expected labor market data in the US, a small increase in US annual inflation rates, higher oil prices, and obviously the win for Donald Trump in the US presidency. But I think this jump in bond yields has presented an opportunity not only for bonds, but assets that have been viewed as bond proxies, such as listed real estate or listed infrastructure, which Nick will touch on the infrastructure side. But that has presented an opportunity because over the long term, the expectation is that inflation will start to come back down, as I mentioned in the previous slide, coming within inflation targets. And so what we should see is bond yields start to follow that downward trend as well, which is a positive for asset valuations. And then the last thing I'll touch on is obviously what today's webinar is all about is artificial intelligence. AI is more than generative AI, things like ChatGPT. It's a bit more than machine learning. It encompasses, things like autonomous and sensor technology, AI robotics, computer vision, and natural language processing. So there's a whole range of different uses for artificial intelligence. And what has been forecast is the AI market is expected to reach about US 184 billion in 2024, and expected to grow at an annual growth rate, compound annual growth rate of 28.5% roughly between 2024 and 2030. So continued growth over the next few years. So this really translates into AI market volume growth of about 826 billion by 2030. So that volume or use of AI is expected to continue to grow. And what does that mean? As I mentioned at the start, investors are trying to find alternative ways to invest in AI, not just directly in AI. This does impact, things like utility stocks, because the AI will just need a significant amount of power or energy, in terms of consumption. And I'll let Nick touch on those points. But yeah, really expected to increase in volume over the next few years in terms of AI. So what does that mean for investment portfolios? So, whether it is a US presidential election, market volatility, really the best course of action, which one of our key philosophies is sticking to your long-term financial plan and trusting that, the key the key pillars of diversification, focusing on those quality investments for your portfolios, maintaining a safety buffer, will continue to provide a stable base for your portfolios, and whether any market volatility, obviously rebalancing client portfolios is key as well, to make sure that you're not overexposed or don't have enough exposure to that level of risk. That I think that's the key thing for our clients, is looking through the noise and focusing on the pieces that really matter in investment portfolios. And with that, I'll hand back to Andrew.
Thanks so much, Sarah. It's amazing. Sometimes it's only when you reflect on that year that you realize how much was really going on, how much uncertainty there was. And yet, despite that, we generally had a nice positive return on the markets for the year. And so looking ahead to next year, as you've outlined, there's a lot of uncertainty again. But I think your advice and those principles that you've outlined, that's really key to success moving forward. So thanks very much, Sarah. Again, any questions that anyone has, please use the Q&A box at any time on the Zoom menu. I can see a couple already coming through, and we'll try to get to those, as many of those as we can at the end. All right, now I'll welcome Nick Langley from ClearBridge Investments. So in 2006, Nick co-founded ClearBridge Investments, a specialist global listed infrastructure firm. He has 29 years of investment experience. As a portfolio manager, Nick is a member of the investment committees responsible for all global listed infrastructure strategies. And he was previously the CFO of Duet as well, an ASX-listed investment trust that had $5 billion worth of gas and electricity assets. So he's very well qualified, and I'm sure you're going to find Nick's perspective on how AI is impacting the infrastructure sector very interesting. So over to you, Nick.
All right. Thank you, Andrew. Welcome, folks. We'll talk a little about infrastructure in particular, how AI is impacting some of the themes that are running through portfolios. Just a little bit of background, as Andrew said, we've been running in listed markets since 2006. Prior to that, the core of the investment team actually was involved in private markets infrastructure. So we've kind of sat on both sides of that investment thematic. We have a dozen people in the investment team, all located in Sydney. We travel around the world, meet companies, regulators, other industry participants, and we bring all that information back to Australia and process it here and take our investment decisions here from Oz. And the reason for that is that means that I can have all the members of the team around the table as we're making decisions about portfolios, and that really helps us in terms of the collaboration and the discussion and challenge that you need inside of an investment team. And out of that, we think we get better issue discovery, and out of that we should get better investment outcomes for our clients. So let's talk a little about what we consider to be infrastructure. Having come from the private markets, and we kind of apply that listing or that lens of valuation and approach to the listed market. We're quite purist in terms of what we think is infrastructure. Really, we're looking for companies that have very long-term predictable cash flows. And so it really breaks down into two categories. You have your regulated and contracted utilities on one side. So think poles, wires, pipes. We also include some renewables in there. These companies are generally monopolies, and so they are regulated. The regulator tells the companies how much they're allowed to earn. It's usually an earning, a return on their asset base, or a return on the equity that they own in their asset base. And if they're earning too much, then they need to give some back to their customers. But if they're under earning and they're a well-run company, they get to increase their prices to come up to that allowed level of earnings. And so that means that they're pretty defensive, right? Because you've got your downside largely covered. It means you're not going to make super profits, but they're pretty attractive looking returns. So on the electricity and the gas side, the company's involved in what we call distribution. So the poles and wires in the streets and the suburbs, those guys are earning anywhere from 8 to 11% return on the equity that they own in their underlying asset base. The transmission companies get a little bit more. There's a bit more of a premium there. Those are more the high voltage wires that connect the power generation facilities to the rest of the grid. So those more, let's call them defensive, regulated and contracted utilities have good downside protection. They get a reasonable share of the upside in up markets. They tend to be more mature companies and assets, and so they have higher payout ratios, which means there's a bit more income that comes through from those companies as well. They also have a very good pass-through of inflation. We'll chat about that as we go through. So, as you get an uptick in inflation, the next time you see your regulator, you get to increase your prices to see that come through. We mix with those companies in the portfolio. We mix in some user pays assets. So here, think about anything that's involved in moving people or goods around the economy: roads, rail, ports, airports. These companies generally have the pricing side of their business model fixed either by regulation or concession contract, but they are exposed on the usage side. So think about these companies being a bit more GDP or business cycle exposed companies. They are the ones that will do well when the economy is growing quite strongly. And similarly, as you get later into the business cycle, our process tends to tilt us more and more towards those more defensive, regulated and contracted utilities. That provides us some downside protection as we go through a recession or a slowdown, and then the process kind of weights us back toward the user pays assets, and we catch some of that growth coming out of markets. So let's talk a little about some of the themes that are running through the portfolio at the moment, one of which obviously is AI, and we'll talk more about that as we go through. But interestingly, the biggest driver currently is the decarbonisation and energy transition push. And what's happened is we have high-level public policy support. So governments have said we're going to decarbonise our economies. The way they're talking about doing that is essentially moving everything that we can to electricity and then powering the grid with as much renewable energy as possible. So that's obviously a process. It's going to take some time, and it's going to be very expensive, right? And to put some numbers around it, our view is, and this is both the bottom-up calculation as well as a top-down sense check, our view is it will cost the globe, the world, about $100 trillion over the next 20 to 30 years. And that's kind of a conservative estimate. So, we are talking an enormous amount of expenditure. And when you think about those poles and wires and pipes companies, they get paid on their asset base. So if you've got this huge amount of expenditure and you're investing in your asset base and your asset base is growing, even if your regulatory returns are stable, then you're going to have growing earnings, growing cash flows, and growing dividends. And so that's one of the main themes that's driving our investment and our choice of assets or companies in the portfolio. Aligned with that, we have a massive amount of spending on both mitigation and adaptation for climate change. So we're seeing in some cases more frequent, but certainly more severe storms. If you're in the US, you've got severe hurricanes in the south and the southeast. You've got ice storms in the northeast, and you've got wildfires in the west. All right, all of those things obviously affect infrastructure. And what the regulators have asked the companies to do is to spend more money to improve the resiliency of their networks to reduce the customers' time off supply during these natural catastrophes. We're seeing similar things in the UK, for example. We're going through a water regulatory reset at the moment. A lot of expenditure that the companies are expected to do over the next 5 years relates to the fact that in the UK, the weather patterns have changed. And so when it rains, they get a larger amount of rain in a shorter period of time, and it's overwhelming a lot of the infrastructure, from stormwater drains to treatment facilities and so on. So in the UK, the water companies are expected to grow their asset bases by 30% over the next 5 years. And obviously, asset base grows, steady returns coming through from the regulator means, again, growing earnings and cash flows and dividends. Now, the AI and the AI thematic, which is kind of power and data for us, is a growing theme in the portfolio. My sense is actually it will overtake at least one of those other two themes over the course of the next few years. We're not sure at this stage just how significant the power demand is going to turn out to be, with a kind of a 5 to 10 year horizon around that. I'll talk more about that thematic as we go through this presentation. Finally, a couple of points. That inflation hedge is really important for us. So most of the portfolio has a direct or an indirect link to inflation. And so as inflation increases over time, our earnings and our returns increase as well. Now, there can be a bit of a lag. So those of you that are invested in the product, will have seen that we lagged behind a little bit in 2022 and the first 3 quarters of 2023. But as bond yields topped out and then the inflation pass-through came into earnings for the companies, which started really in late 23. We got more this year. We'll get more again next year in terms of that uptick in earnings. We've had a very strong period of performance in the portfolio, and we're hopeful that continues into next year and beyond. And finally, just around some floor support for valuations. The private markets part of infrastructure, currently has $300 billion worth of dry powder. They'll lever that 2 or 3 times, and so that will be somewhere between $750 billion to $1 trillion worth of assets that they'll be looking to acquire over the next 3 to 5 years. So there's no doubt that some of that will come out of the listed markets. Our market is about $7 trillion worth of assets, so we are bracing ourselves to lose a few companies to the private markets guys over the next few years. So let me talk a little about some of the power growth that we're seeing being driven by this AI dynamic. And listen, to be clear, you see a bunch of straight lines on the page here. I keep saying to my analysts, nothing ever happens in a straight line, and AI is one of those very tricky areas. So I prefer them to work in what I call orders of magnitude, OOM or ohms, and so I tell them that you can think in linear ohms. Like you add 1 or 2 or 3 ohms a year to this dynamic, and an ohm or an order of magnitude is 10x, right? And that is actually the speed at which, measurable speed at which, we're moving in terms of development of some of these models and, the progress toward general intelligence and things like that. I won't go through the wording on the graph, on the chart here, but what I do want to explain is, the latest and greatest chipsets that NVIDIA has, the H100 chipsets, are 700 watts of power. Now, when they're running at near full utilization, doing the compute for AI, for these models to learn, when they're running near full utilization, they have the same power draw as about 1.5 average households. Now, that's a lot. The B100 chips that they're the Blackwells, which they're planning to bring out next year, will be 1,000 watts, and so they are going to be 50% more power hungry than the existing chips. Now, okay, 50% more power hungry. They'll be 5 times faster in terms of their compute, but I don't think there's any tech company out there that's going to say, well, we can reduce the compute ratio because we can now use less energy. They're going to run them full tilt. And, to give you an understanding of kind of what that means, so Meta trained its Llama 3 large language model on 16,000 of these H100s. And so if you think about it, that's the same power draw as a town of about 50 or 60,000 people. Their Llama 4 model is being trained on 160,000 of these things. And so that's equivalent to a city of 500,000, right? And it's, once you've trained the model, you then put it out into service. And so when it's into service is, that compute continues. That's called inference at that stage. And so you've got a massive amount of power. Literally, we are building whole cities in terms of power demand as quickly as possible. And so that's why, you've seen quite a ramp in expectations and certainly in some of the prices of some of the companies. Final little anecdote here. Elon Musk's AI company, xAI, has just put in service a new data center. They have 100,000 of these H100 chipsets in the data center. There's a video on YouTube. I encourage you to take a look at it if you're interested. It has water cooling for the chipsets, and then air cooling for a lot of the other peripherals and so on. And it is so powerful that when they spin up the data center and all these chipsets, so they literally send a compute command in there, it actually destabilizes the grid. And so what they've done is they've built the data center, and then next door to it, they've got this enormous Tesla battery, and the grid plugs into the battery, and then the battery plugs into the data center to kind of stabilize the draw on the grid. So the battery acts as a big kind of shock absorber in this context. Now, when they've really got the thing spinning, as in the data center, they need more power than they can get off the grid. So outside the data center, also plugged into the battery, and this is not in the video and not reported anywhere, there are 17 mobile gas-fired generation facilities. They run on methane. So not particularly environmentally friendly, which is why you won't see it reported anywhere. But these things are also plugged into the battery to provide excess power when the data center goes into overdrive or they can't get enough off the grid. So, the dynamics and the infrastructure around this build out is just going to be quite incredible over the next 10 years or so. And I think that, the one thing that is really important to understand is, or two actually. One, the speed of which this is moving. So please do think in orders of magnitude. And the second is, the US will figure out very quickly, if they haven't already, that they're actually in an existential race with China to reach artificial general intelligence, because the next step beyond that is super intelligence. So, and it's likely the first country or person, group, whatever, that gets to that artificial general intelligence will then be able to utilize that to develop the super intelligence. And it could well happen inside of this decade. And so the demand for compute is going to become, part of this existential race, and that is going to be, a big deal for at least two countries in the world, and for many others of us who are allies to one side or the other. We'll see how this goes. So. Not only does it have massive investment implications, it's actually got quite significant geopolitical implications as we move forward. Now, if we just put that power demand to one side, because it is enormous. We on the previous slide we'd said, okay, maybe this goes to 6 or 7% of total power demand by 2030. If it really begins to accelerate, you could see this AI demand for power being, something like 20 or 25% of total power demand by 2030. So, it's just astronomical. Now, we talk here about on the revenue generating side. So obviously, it's increasing in power demand. powering decarbonisation is an interesting one because the push for more power into AI is actually developing more renewable energy coming through. Now, having said that, there's a tipping point. You can only build out the renewables so quickly, and I think what will end up happening is, we'll be adding in other forms of power generation as well. Obviously, nuclear is the big one. There's been a lot of discussion about that. We'll talk about that in a moment as well. So that decarbonisation is getting a boost. But I think we will go over the other side of the tipping point, and so we'll end up using just whatever we can to generate electricity to satisfy that power demand. And obviously, with that comes an enormous increase in capital spend. And one thing that is interesting for those of you who are very investment minded. 10 years ago, a high growth utility in the US was growing its asset base at maybe 4 or 5% a year. Today, that's more like 8 to 10%. So we've had a doubling of that growth rate. And I think we'll see the higher growth utilities, push up towards 12 or 13% annual growth in the underlying asset base. And obviously, that drops down to earnings. And so your earnings are growing at roughly that pace as well. What's interesting is when you look back at the trading multiples, so the valuations of these stocks, they've been pretty steady over the last 10 years. And so, on a multiple for growth basis, they're actually looking a whole lot cheaper now than they have done at any stage over the last decade or so. On the cost side, which is something we don't talk about a lot in terms of AI actually having a benefit, but there are huge opportunities to optimize grid operations and things like that. And this is all about having sensors spread out across your grid, which a lot of the utilities are doing now, and then utilizing the AI to manage the power load across the grid and get a better sense of where the load centers are and how those load centers are changing, which should result in a much more stable grid over time. Let's see how we go. There's work to be done there. But there are other practical areas in terms of call centers. There's about a 20% improvement in the productivity of call centers already from the use of AI. But also areas like predictive maintenance in operations and things like that. So they'll be able to work out which individual solar panels may need to be replaced in a solar farm. So rather than running a program of replacing the whole farm, you run the panels until they fail and you replace individual panels. That will actually save a lot of money in maintenance and so on. So let's talk a little about some of the companies in the portfolio. Dominion is an interesting one. It's a big utility. Its main area is in Virginia in the US. Virginia is obviously government town, and so they have an enormous data center business, as in they supply energy to data centers, and they help build the power component of data centers. And a big data center nowadays, Microsoft's trying to build 1 gigawatt data centers which are, believe me, enormous. And those data centers are about $13 billion US to build. About $1 billion is the power component. And then about 6 or 7 billion is the chipsets, the NVIDIA chipsets that go into it, and then the remainder is all the civil works and actually putting the labor to put the whole thing together. So we're talking about significant 1 gigawatts data centers today. By 2028, we think Microsoft will have built its first 10 gigawatt data center, and there are expectations that by 2030, we'll have clusters of up to 100 gigawatt data centers. And that's at the high case where data center load is kind of 20 to 25% of total power usage. So again, orders of magnitude times 10 times 10. This is going to get very large very quickly. So, Dominion is a first mover in this space. They're already the largest market for data centers. What's interesting about Dominion is most of the data centers service government. And so those data centers are going to get built, right? Because government is going to be a massive user of AI and therefore of the data centers. So this is an area where we see these guys continuing to add to their pipeline. We've said here, we expect it to quadruple over the next 15 years. That's to roughly 15 gigawatt. In their Q3 announcement a couple of weeks ago, they announced they've added another 5 gigawatt to their development program. So they're already actually well above 20 gigawatt. And so we will see this build out continue quite rapidly. I do think interestingly, over the next few months, the market is going to realize that they have underpriced the amount of growth in the kind of the 5 to 10 year timeframe. I think the market is also going to realize they're probably overestimating how quickly this will come into earnings, and that's because it takes a good 3 to 5 years to get all the planning, get all the equipment together, and actually build these things. So we're seeing a lot of activity. There's a lot of hype. And I think we'll get a rebasing of expectations over the next few months, and then that'll be a great position to take a stake in some of these companies and ride that growth out significantly into the future. The other point I touched before about the different generation sources. There's a deal that's been done between Amazon, Dominion, and a small nuclear reactor company called SMR. And so we are starting to see kind of the new generation of nuclear being discussed as being part of some of these data centers. So that's early stage. That kind of technology is still probably 5 to 10 years away. 5 years to get first commercial in service, 10 years until we see it more broadly used. Let's talk Constellation Energy, another US company. This is the largest operator of nuclear plant across the US. They also happen to be the most efficient operators. We measure that on the right-hand side there with what we call the capacity factor for these plants. So that basically says you get a nuclear plant that's running almost 95% of the time. Compare that to your solar plant that runs at a utilization of about 24, very efficient ones about 25%. So these nuclear plant are very important for things like data centers. And what we're seeing with Constellation Energy, or SEG, we call it CEG, great management team. They've actually been going out and buying land around some of their existing nuclear facilities with the idea that they can lease that land to data centers, the hyperscalers build the data centers around the nuclear facilities and essentially plug them directly into the facilities. And that's what we term a behind the meter deal. And there are areas in the US where there's actually excess power. And that's being eyed by a number of these hyperscalers. They're also looking to restart some decommissioned plants. And they've just announced a deal with Microsoft where SEG will restart one of the 3 Mile Island plants. That's, if you remember, it had a meltdown in the 1970s. It's not that particular plant they're going to be restarting, but one close by. And that will go to supply some of these data center markets. So it's going to be a very strong growth profile for these guys as well. I looked with some envy at some of Sarah's mag trio companies and the returns over the course of the year. I should note that Constellation is up about 100% this year. So that's very unlike an infrastructure company. Let me be clear about that. Right, let me touch on kind of portfolio positioning and returns outlook, and then I'll wrap up and we can go to some questions. So listen, as we think about the portfolio, we usually run about 35 names. Each name has a specific allocation of capital in our minds, and we allocate capital to an idea. We have a view about what we think it's worth based on our assumptions. We have a view on why the market is mispricing it, i.e., why does the market have different assumptions to us? And then what we say is, okay, what are the catalysts or the events that are going to cause the market to change their assumptions to ours? Right? And so as those events unfold, the market should come around to our way of thinking and the stock should rally. And if it's coming toward us, it's all good. We're making money. If it's moving away from us, then we need to rethink that position in the portfolio, because clearly we don't understand why it's trading the way it is. And so when we look at these companies, we have a specific investment thesis for each one and a time frame for that thesis to play out. And generally, we're investing in these companies with a 5-year view. We'll hold them for about 4 to 5 years in the portfolio. Investment thesis plays out, and then we redeploy that capital into the next best idea. So as the region and the sort of the sector exposure plays out in the portfolio, it's kind of an outcome of the stocks that we've chosen. And you can see when we look at the regional exposure, it's really about North America and Western Europe at present. North America, obviously, you've got the tailwind of public policy support, the IRA. If we get to it in question time, we'll talk a little more about what Trump thinks about the renewable sector and what impact he can actually have there. We think it's going to continue to grow very strongly. We've got good public policy support. We've got good commercial opportunities for our companies, and we've got very strong demand for their services, particularly in the power sector. In Europe, we see big targets on the renewable side from the European Union, and we're starting to see the regulators actually allow the companies to spend a lot more money on the poles and wires in their grids and increase the allowed returns. So that's important as well. And then when you look at the sector exposure, it's very heavily in that electric space. It goes to that decarbonisation theme. It goes to that resilience spending across networks, and obviously, the AI demand for power for the data centers. A little bit in renewables, but obviously, cautious as it looked like Trump was going to get into the office. We trimmed that a little bit. And then, we're balanced across kind of almost 2/3 of the portfolio, 63% in those poles and wires and pipes, a little bit of renewables. So that's the more defensive end, and about 35% of the portfolio, exposed to some of the economic trends and that business cycle. We do expect a slowing of the global economy as we move into the earlier part of next year, and so there's a little bit of reticence to hold too much of that infrastructure exposure as we go into that. Take a look at the bottom left-hand corner there. Most of the companies that we're investing in are pretty big companies, so we're medium and large cap exposure here. $45 billion average market capitalization of companies. Forward dividend yield 3.5%, so there's pretty good income coming off the strategy. And importantly, the dividends are growing at about 8.5% a year. So that's recognizing the underlying asset-based growth underpinning a lot of these companies. And then finally, just on the forward return profile, this is taken actually directly from our financial models for each of the companies that we invest in, take a weighted average to give us an expected return for the portfolio. And so this is an annualized return over the next 5 years on a local currency basis, and that's total return roughly 12% per annum over the next 5 years. So pretty attractive return profile from the portfolio. recognizing again, that growth that's sitting inside of the companies in the portfolio. Let me pause there, Andrew, and take some questions.
Fantastic. Thanks, Nick. Incredibly interesting. Thanks for teaching me a new acronym as well, an I appreciate that. Just what I needed, another one of those. Yeah, slightly scary, but incredible statistics that you're putting out there. And, rather than trying to speculate on the latest and greatest AI company, seems a pretty sensible way to get exposure to such a growing sector. So thank you very much for that, Nick. All right, we've got about 10 minutes for some questions for both Sarah and Nick. So put those questions into the Q&A box. We've had a couple come through already. Nick, there's a really good question here that's not so much related to investment, but more just living our everyday lives. And you spoke through some of the numbers about the increase in the power demand. Is it fair to say consumers will be competing with these tech companies for power? And does that mean more blackouts and so forth for us? And what does it mean for our bills?
Yeah, so listen, the short answer is yes, and that makes us a bit nervous. It's quite nuanced though. So, what we find is we really haven't invested in our grids, very well over the last couple of decades. And when I say the grids, I really mean the high voltage transmission lines, and they're used to kind of move power around the place. And so we end up with pockets, regional pockets, in every country where there's a bit of excess power. And so those are the ones that are being targeted by the data centers. We'll take that excess power, we'll plug it into our data center. And they say, well, it was excess, and so nobody really needed it. We're buying that power, and so that's good for everyone. And the answer is, well, yes, accepting that, as our power demand increases, as we move more of the economy to electric, for example, every 2 electric vehicles that you add into a service territory, it's like adding 1 house. So, we may not be competing with that tech company for that power today, but we sure as hell will be in 3 years or 5 years, and so on. And so there is going to be a big build out that is going to hit our bills, unfortunately. Interestingly, though, as you add more renewable energy to the grid, it's largely a fixed cost, right? Because all the cost is in building it, and then the wind and the sunshine is free, so pretty much zero to operate. And so what that means is that fixed cost in the grid then gets spread over a larger number of kilowatt hours. And as a result, you see a bit of downwards pressure coming on the bills. So that's at the power generation. It's really then how much of the poles and wires do we need to build out to account for all of that new power coming on. So listen, the very complicated answer in a nutshell is expect significant growth in your power bill over the next 15 years, and then over the next 10 years after that, it'll go down to close to zero. And I'll save everybody from the technical analysis as to how that actually works.
Fascinating. Thanks, Nick. Sarah, mixing it up, there's a question here for you around cryptocurrencies. They've had a volatile history the last couple of years, but with Trump getting in, the value's gone up a bit since then. What's your take on cryptos at the moment?
Thanks, Andrew. Yeah, we always get questions around crypto because it is a growing space. I think the way that we view cryptocurrencies is, it's, even though it's been around for a few years, it is still quite in the infancy stage. No, it's still not recognized more broadly as a form of payment, not like you do for money as you have. So I think what we would really need to see is greater use of greater acceptance of cryptocurrency in order for us to have a view on whether we should we should be investing in this type of investment. I think the key thing here as well is regulation. Regulators around the world are still trying to figure out how to regulate cryptocurrencies. So that's probably a key thing that we really need to see in this market, broader use of cryptocurrencies and acceptance of cryptocurrencies and firmer regulation around them.
Great. Thanks, Sarah. All right, there's a couple of questions here. Nick, Australia is a mining nation, so a few of our attendees have asked some questions on how this might relate back to Australia. There's a question around, do you see with that nuclear expansion you've described, is there an opportunity for Australia to do more uranium mining? And also there's a linked question here around with the required investment into renewables, is that going to be restricted by how quickly mining can be scaled up?
So on the uranium side, I'm a big believer in nuclear, and therefore the uranium over the medium and longer term. Here's the thing: I think it's a slow grind higher there, and there'll be more mining and so on. What I do worry about is the speed with which those facilities can be brought on. A large generator is at least a 10-year project, and the small medium reactors, we're probably not going to see them very commercial for about another 10 years, and so it's quite likely that we really up the ante on the battery technology between now and then. And a lot of our power is then done with solar and battery technology. So there's quite a race for that nuclear technologies to get a place in the grid in the near term.
Interesting. There's a couple other linked questions here, Nick, around the capex requirements. So, firstly, with Trump's policies around tariffs and so forth, potentially creating some inflation and the costs of all of this going up, but then also just the huge amount of capex that you've described that it takes to build these facilities and do these things. Who else do you think might benefit from that? Is it banks, private equity, other sectors other than just the infrastructure company themselves?
Yeah, so it's a bit of all of them, Andrew. So you're right, the capex is enormous. That capital has to come from somewhere, and frankly, the governments can't afford that capital. They're going to be full on defence, on rebuilding some of their other infrastructure, on supporting households, and the like. And so we do see equity. So it's public equity, public markets, as well as private equity, having a pretty significant role. The regulators are quite prescriptive with the companies as to how much equity and how much debt they should have. And so, banks are going to be doing a lot of financing in this space. And for those of you that follow this sort of thing, that obviously expands the money supply. So just be conscious of that over time. We're going to have a massive expansion of money supply over the next 20 odd years. And so, the funding of that capex is going to be difficult. And I realize I didn't fully answer the question on the materials for the renewable space. We are going to be constrained by our ability to mine, things like copper and process rare earths. And I think we're going to be reminded of that very quickly, as Trump puts his tariffs in place and China responds. They're likely to respond by restricting the export of rare earths, processed rare earths out of China. So I think people should expect some volatility over the next 12 to 24 months because remember Trump's got to get a lot done before the midterms. And so I suspect he's going to be, coming out firing on policies from day one.
Interesting. And around the decarbonisation, you spoke about providers using wind and solar and even moving into nuclear. Is that realistic? And what are the other sources? What about natural gas, so forth?
So I think gas will be a very important one. I think there is a big push to close down coal-fired power, and even though Trump is a fossil fuel guy, though the coal-fired decisions actually get made at a state level in the US, and once those decisions get made, it's very difficult to actually extend the life of these things without spending a lot of money. So I think coal's largely off the table. So I think gas will be very important. Trump's obviously a drill baby drill kind of guy, and when you do that, you get a lot of supply, and therefore prices go down, right? And so we will see very cheap natural gas across the US. Places like the Permian Basin are going to be very important. So I think Texas will be a big area. They've got lots of land to put out solar farms, and those farms could be backed by natural gas. And so, burn the gas at the night, use the solar during the day, for whatever they can't store. So there's a real opportunity for natural gas there. It'll be cheap. They're quick to build natural gas fired power stations. And as I mentioned with the XAI example, you can actually build them into mobile units and literally, put them on the back of a semi-trailer. And so XAI has 17 semi-trailers parked outside. So there's lots of ways for gas to play in that. And that's, one of the areas that we've been increasing in the portfolio is that energy infrastructure segment. It's largely the pipeline companies that are transporting the gas around. If there's a lot more supply, then there's more to transport, and therefore those companies are going to do well.
Fascinating stuff. Thanks, Nick. Well, we appreciate your support to the Apt team and its clients. Look forward to seeing how that all plays out over the next couple of years. So everyone, we're out of time today. A big thank you to Sarah and Nick for giving up their time today, and thank you to all of our clients for your support and for coming along. There's a few unanswered questions which we'll endeavour to get answered, and we'll send that out with a recording of today's event. Hope that's been useful. Keep an eye out for our future upcoming webinars and events. If you've got any ideas or things that you'd like to hear about, please let us know, and we try our best to incorporate those into the program. So if we don't see you before Christmas, wish you a safe and happy holiday season with family and friends, and look forward to seeing you in 2025. Thanks everyone for joining us.